To remain updated with the latest business news, click on the bell icon.
It's absolutely great to have our global business editor Udayan Mukherjee with me right here in the studio. Udayan, it's good to have you in the city. And markets at a time like this have been a huge question mark. We've seen immense volatility. First, this massive sell-off, and then the biggest one-day bounce we've seen in 10 years. What do you feel is happening? How much of it was to do with Ukraine? Is that behind us, or is the Fed a bigger threat?
Nice to be in the studio with you, Aabha, for a change. It's very nice to be in Delhi after a long time. But I haven't seen volatility like this in a long time. You know, 500 down on the Nifty and then 500 up the next day. It's insane volatility. And I think it's reflecting the kind of mood in the markets globally and locally at this point in time. People are very unsure of how this story will play out. Because it's not just Ukraine. Ukraine is causing a lot of flutter at the market and deservedly. And I think it will also feed into the price of crude, which will nudge $100 very soon, and that matters a lot for India at a time when inflation is already quite high. So I think that is part of the problem. The bigger part of the problem is that we are having something which is happening once in a decade or once in many decades, which is after many, many years of very easy money globally, we are having interest rate hikes. And things are actually accelerating on that front. Earlier we thought that it would happen later in the year. Now not only has the time been brought forward, people are talking about 2 hikes together. Some are even saying 3 hikes together. And you know, so locally inflation is a problem, crude is a problem, geopolitics is an issue, and the US Fed is the biggest issue of all. So all of it put together has led to some incessant selling from the FIIs, which has shown up in big marquee stocks like HDFC Bank and HDFC and all of those names. So I think we are in a lot of flux at this point, and probably this volatility will continue. And I don't have the heart to say that we've seen the worst of the correction. It's possible that the market eventually trends lower after this bout of volatility is done.
So that was my next question, and I'm going to remind our viewers that we will have the Ask Udayan segment starting again this Wednesday, now that all the budget and post-budget hecticness has abated. But then we'll take those stock-specific queries. But the larger question from investors will, of course, continue to be, should they invest even at dips? Those that have become used to making a lot of money in this market may be in for a disappointment. Should they be booking profits? Should they remain invested? That's, of course, the most natural question from a retail investor.
You know, I think I will say 2 things, Aabha. One is that this is the first proper correction in 2 years. I mean, after that big COVID fall in March 2020, we haven't seen a fall of this magnitude and this volatility. So in a sense, this is the first test for those young people who opened accounts over the last 2-3 years. They've never experienced something like this. So I think they will be tested. How much they will be tested depends on how deep this correction turns out to be. If it is 16,000 Nifty, 16,500 Nifty and no further, I think they'll probably ride it out because that's a 10% correction and that's not very deep. If 16,000 gives way and we head to 15,000 and lower on the Nifty, I think a lot of stocks will fall 25%. And that's going to be a big challenge for a lot of these new investors. So this is the asset test of the maturity of these new investors and whether they can take such big falls in their stride. What should they do now to answer your question? I think anybody who's trying to deploy fresh money into the market should not do it in one shot at a time like this. Because no matter what analysts tell you, we cannot know for sure that 16,500 is the floor for the market. You know, it's an opinion. It may be right, but it's still only an opinion. My sense is that the best course of action at this point is to say, if I have 100 rupees of fresh money to invest, you probably stagger it over the next 3 months. Buy some now on the very bad days, and when the market falls again, buy some more. If you're already invested, what should you do is a more tricky question to answer, because it seems easy to suggest that you sell now and buy later, but that never is done so easily in real life. So I think for those people who already own stocks, maybe you clean your portfolio a little bit. Take out some of the higher beta names, some of the commodity stocks, etc., because they'll probably fall a lot more than some of the more stable names. But for fresh money, I would say patient, don't buy it in one shot. Do it over 2 to 3 months, because this volatility will last some time.
It's going to be here for a while.
Some time at least.
Have to ask you on those tech stocks as well, because some of the volatility has been in some of these new age assets, whether it be tech stocks, crypto is a whole different discussion. But you know, even that warrants a question. Perhaps if we have time, we'll take it. On the tech stocks, we were waiting to see this come.
Yeah.
And we're seeing the volatility. But is it too early to write them off? What's really the verdict? And then we also have, of course, this mega IPO that's coming, LIC. And it's really starting to make everyone wonder whether it's going to suck out a lot of liquidity from the market and also add to the existing volatility.
No, LIC is a bigger discussion for another day, so we should keep it for another discussion. But for the Zomatos and Nykas of the world and the Paytms of the world, I think this was inevitable. At some point, this had to happen because those valuations were just not sustainable. They were based on nothing. Now that many of these stocks have halved, it's a more interesting question. Do you get in here because you're not buying at the IPO price or 100% more than the IPO price? You're buying at, in most cases, 60-70% of the IPO price. Better entry point. The difficulty is that the kind of business models many of these companies have, not all, it's difficult to sustain IPO price. It's difficult to sustain or explain even half X of the IPO price because they're not based on cash flows and real things. They're based on promises.
Yes.
So in some cases, and I would probably make the only exception of Nykaa. Nykaa is a company which actually makes profits, has cash flows, and it's not a pie in the sky like Paytm. So if Nykaa comes to a discount, a significant discount to its issue price, I would say it makes an interesting proposition. Paytm you just can't value. I mean, at 1200 it was expensive, at 800 it looks expensive, at 700 who knows. It's a leap of faith. So I would say that if you really think the franchise is great, like some people believe Zomato is a great franchise, then you can start nibbling at these kind of levels because prices come off quite a bit. Better still to look at something like a Nykaa. But otherwise I would say that most of these companies who have hit the market, these digital companies, I still think if the market volatility extends, you may find them even 20% cheaper from where they are today, despite the amount that they have fallen. So it's still a difficult call because of the lack of supporting cash flows.
All right. Well, we all have a lot of questions for then, on some of these individual companies, on the upcoming LIC IPO, on some of the other big moves in the market. So do send us your queries. We'll take them every Wednesday.
And keep wearing the jacket. We need that color back on the screen.
All right. I promise to do that. Udayan, thanks so much for joining us. And we look forward to seeing you.
If you like the video, do like, comment, share and subscribe.